I've often said that most property investors fail, and this is backed up by statistics from the Australian Tax Office. Of those people who own investment properties, 73% own one property, 18% own two investment properties, only 5% own three properties, 2% of investors own four investment properties, 1% own five, and only 15,264 Australians own six or more investment properties. In other words, most Australians who get into property investment never achieve the financial freedom they aspire to. And worse still, many property investors lose a heap of money along the way and lost opportunities. When many new or prospective clients come to us at Metropole for advice, they bring a litany of complaints with them about their previous experiences. And since we can learn from such experiences, I thought it'd be worthwhile sharing some. So here are 11 of the common complaints that we hear from property investors. Firstly, it's the problem of poor property selection. One of the common complaints we hear is about having missed the recent property boom that others who invested in the right property markets recently have enjoyed. In general, these investors who are complaining have bought the wrong properties and didn't get sufficient capital growth. Some bought off the plan and they overpaid for their properties, and others bought in regional Australia where property values, they just didn't increase as much as in the big smoke. Now, sure, I know some experts recommend investing in regional Australia, but I avoid these locations. You see, jobs growth is slower there, unemployment is higher, wages growth is generally lower, and there's no shortage of land. All this obviously transfers to lower population growth, less demand for properties, fewer growth drivers. These are the things that lead to capital growth. The second complaint is from investors who've had difficulty holding onto their properties because they hadn't organised their finance strategies and structures correctly. They didn't have the cash flow buffers in place to cover their negative gearing shortfall. My preferred financing solution to allow you to own high growth properties and service the cash flow shortfall is to set up a line of credit. Then use this facility to fund your property portfolio shortfall, things such as interest on your investment loans or your property expenses, and importantly, keep a rainy day financial buffer aside just to buy you time if the market turns. However, to be tax effective, it's critical to set up these structures correctly, so it's important to receive correct advice. Other investors complained because they came to realise that they owned their investment properties in the wrong entities. They didn't seek structuring advice before they purchased their property. I've often said it's important to begin with the end in mind. What will your property portfolio look like in 10, 15 years' time? Will you be working then, or won't you? Do you want to leave a legacy to your children? In other words, what entities would you like to own your properties in then? Obviously it's important to think about these things before you buy a property and then purchase them in the correct entities. Another complaint that I'm hearing a bit too often is people who've left their investment run too late. They're now approaching retirement and suddenly they realise they haven't built up a big enough nest egg. The worrying reality is that more than one half of Australian baby boomers currently believe they're going to run out of money and they're going to need the age pension, while many others will have to significantly scale down their lifestyles. Clearly, superannuation isn't going to be enough for most Australians, and it seems like the government isn't going to be able to fund the type of lifestyle most of us would like in retirement. One solution is for baby boomers to use the equity in their homes to invest, rather than trying to pay off their home loans. Of course, they're going to need to invest in the right type of property. They can't afford to make the common mistakes many investors make because their time frames are much tighter. Other investors come to us complaining they weren't sure where to turn, and they sat on the sidelines through this last property cycle. I've found many didn't invest because of information overload. You know, what some people call analysis paralysis. They just didn't know where to start. Others tried to time the property cycle, and some are still waiting for the conditions to be just right. My advice for these investors will be not to try too hard to time the property cycle, and to remember, Australia is not just one property market. Each state is at a different stage of its own property cycle, and in each state there are multiple markets, some geographic, some by price points, others related to different types of properties. Sure, it's hard to work out where you are in the property cycle, and that's why I recommend getting the investment strategist at Metropole as part of your team. Our on-the-ground knowledge in the various property markets in each state help us cut through all that clutter of mixed messages. Unfortunately, another common complaint we see is from investors who bought properties off the plan from a property marketer that just haven't achieved the capital growth or the rental growth that they wanted over the years. Now, do I believe buying off the plan properties makes a good investment? Look, if you've been following my blogs, you'll realise the answer is no. While a few investors have made money buying off the plan, the landscape is littered with many, many more who've regretted their purchase. Frequently, they found the value of their property on completion is considerably less than the contract price. And some are going to have to wait over a decade before they see any capital growth or rental growth. In general, they would have been better off buying an established apartment rather than a new one. Many unfortunate investors bought the wrong property because they looked for the next hotspot. Whilst they may have enjoyed some short-term capital growth, since then property values have dropped, as have rentals, and many now have negative equity, especially those who bought in mining towns. Many of Australia's worst performing property markets over the past few years have mirrored the ups and downs of the mining sector, and many investors have been burned by following the advice of so-called hotspotters, those who recommended those mining towns. I've often warned about investing in one industry location such as mining towns, not only because they lack multiple growth drivers, but because they tend to be dominated by investors who are speculating rather than owner-occupiers who give stability to the market. Then there are those investors who didn't maximise their tax position because they didn't obtain a depreciation report. Depreciation deductions can make a real difference for investors, helping them reduce their taxable income. Another regular complaint I've heard is from those who've tried to save money using a cheap property manager, or worse still, self-managing their properties and running into troubles. A good business owner recognises they can't do it on their own. They've got to surround themselves with a good team of professionals to help them effectively, to help them manage their interests and generate the best possible profits. And the same should apply for a property investor. Employing a proficient property manager is going to maximise your investment returns. The internet is littered with stories of investors who've succumbed to property spruikers' tactics, including high-pressure sales tactics, at the end of a seminar where you rush to make a decision, sign a contract straight away, pay a fee, discounts because you've been there at the seminar. Other tactics used by spruikers are claims of strong capital growth rates that may not independently be credible, or pandering to those who haven't got sufficient funds to be able to buy a property by claiming no money down deals. Similarly, those who bought from property or project marketers who were working for the developer often lost out because the advice they received was far from independent. Another complaint I hear from investors is that they haven't built a good team around them. They've suddenly realised that they can't be an expert in everything, and they realise that they are not the smartest person on the team. In fact, having a good network, including a finance broker, a smart solicitor, a property-savvy accountant, a knowledgeable property strategist, such as the team from Metropole, is going to get you closer to your goals. Well, there you have it, 11 common complaints I've heard from property investors. I guess that's why I often say property investment is simple, but it's not easy. So what's the alternative? Clearly many property investors fail to achieve the financial freedom they desire. So the answer is not to do what the majority of investors do, but instead invest strategically like a small group of investors do. True wealth is built through property in stages. I see them as follows. Step 1, you've got to have a success mindset. This is the most important layer because it's the foundation of your wealth. If you don't get your head in the right place, you're just going to suffer. Your wealth success mindset consists of your beliefs, your habits, your thoughts, your behaviours regarding money and wealth. Next, you need skills and knowledge. Most of us are just not taught how to invest right, so we need to find the right mentors to speed up our journey. Then you've got to have the right property investment strategy. Many fail because they follow a flawed strategy. In my mind, residential real estate's a high growth, relatively low yield investment. So don't try and invest for cash flow. The next step is to manage your risks with the right ownership structures, having sufficient financial buffers in place, and owning the right sort of properties, having insurance to protect yourself, and surrounding yourself with a good team of advisors. Step 5 is cash flow management. While I believe it's essential to invest for capital growth, of course I recognise the importance of cash flow management. Therefore, you've got to have the right rental returns and the right financial buffers. Cash flow keeps you in the game while capital growth gets you out of the rat race. Step 6 is to invest for capital growth, so you've got a sufficiently large asset base to one day replace your personal exertion income, so you can choose to work if you want to, not because you have to. So what's next for you? If you'd like to not make the mistakes a lot of these investors complain about, and if you'd like to cut through the clutter and build a portfolio that will give you that financial freedom one day, why not have a chat with the team at Metropole? We have no properties for sale, but access to every property on the market. Whether you're a beginning investor wanting to know which way to start, or a seasoned investor wanting somebody just to have a look at your portfolio to see how it's performing, why not give us a call, attend one of our offices in Melbourne, Sydney or Brisbane, and let's do a strategic session to see what your options are.